Good morning and welcome to Bloomberg UK. A special focus on the biggest challenges facing the British government, economy, financial service and the markets. I'm Kriti Gupta in London. Now relief for the Bank of England and the UK government this week as inflation slowed far more than expected in the month of November. Consumer prices rising only 3.9% relative to a year earlier. That is down from the 4.6% figure in October. But get this, no economist had expected a rise of less than 4.2%. That surprise figure fueling optimism of a dovish pivot by the BOE next year. 5 quarter-point cuts now fully priced into the market. Similar easing expected by the Federal Reserve and the ECB. But UK CPI still remaining elevated compared to the EU and the United States. Chancellor Jeremy Hunt, whose Conservative Party is trailing by a large margin in national polls, said that the battle against inflation and cost of living crisis still has a way to go.
What the government does in terms of tax and spend and what the Bank of England does in terms of interest rates work together to bring the inflation rate down. If we hadn't taken those difficult decisions, we wouldn't have this dramatic reduction in inflation today. But there's still further to go. Inflation never falls in a straight line. And what we want to do for families up and down the country is to move away from this era of prices continually going up.
Now here to talk about the UK outlook into the new year, Bloomberg's John Stepek and Philip Aldrick. Happy holidays to the both of you. John, I'm going to start with you here. When we're talking about what's actually getting priced in from the Bank of England in particular, look, they were supposed to be the last hawk standing. Doesn't sound like that's going to happen. Is the market getting this one right?
Look, honestly, I think 5 kind of quarter-point drops next year is possibly a little bit optimistic. But certainly the idea that the UK specifically had an outlier inflation problem is starting to look less correct. Because in August or earlier this year, people were saying that the UK specifically had a major inflation problem that was different in nature to the other countries, particularly in Europe. Whereas now we are starting to converge with Europe, and so we're going to look like less of an outlier. So that's positive. So I think the 5 rate cuts is more the market generally has got a bit overexcited across the board, including in the US, about rate cuts by the Fed. But certainly, I think rates have peaked at 5.25, and the next move will be down.
Don't let the investors hear you that they're wrong, John. Phil, walk us through the same narrative here, because there is a real change in language coming out of the BOE. And it feels like the minute the Federal Reserve got a little bit more dovish, so did the BOE. Even Andrew Bailey has been very vocal about still sticking hard with the inflationary story. How quickly does the economic strength that we are seeing in the UK, much longer than expected, actually last?
Yeah, I mean, the language coming out of the Bank of England has been, we've still got to worry about inflation. We haven't had any public comments since yesterday's inflation print, so we're going to see what the reaction is. In fact, just hours before before the inflation shock, the new deputy governor at the bank was saying that we're going to have to see rates stay high for longer. I have no idea. I don't think that they see the inflation numbers. In fact, they don't nowadays. They used to get the inflation ahead of schedule, but. There are reasons to think that as John said, 5 cuts in the next year is pretty aggressive. There's still underlying pressures. The things that the Bank of England says that they're worried about and they've been closely following are wage growth and services inflation. Now, service inflation did come down a little faster than expected, but it's still very elevated, and we haven't seen the big falls in wage growth that need to accompany that. So, I mean, I don't think the Bank of England is going to dramatically change its position. What they're probably going to say is reinforces that they certainly don't need to go any higher. Whether they can start cutting rates imminently, it seems unlikely. You'd expect them certainly to wait until. I think in February they have a whole load of new economic forecasts, which is a chance for them to reframe their narrative. So we'll see what happens then. But there's likely to be a slightly softening in their tone, you'd have thought.
All right, well, let me push back a little bit on both of you, put my dove wings on here. Anna Andrade over at Bloomberg Economics made a really interesting point, and she said that when you're looking at the way the Bank of England reacts to data relative to the Federal Reserve and the ECB, Chairman Powell's favorite line is to say everything is data-driven. Every other central bank says we do it the same way. But she made the point that the BOE in particular is far more sensitive to that one data point. I'm curious, Phil, we'll start with you here. This is the one data point that's a surprise. What could the reaction function actually be besides dovish?
But the thing is that this is the key data point, obviously, the headline CPI number. But they have specifically said that they're looking at wages and they're looking at services and they're looking at core inflation. What they want to see is domestically generated inflation just be taken out of the system, be squeezed out of the system in the UK. They're not saying if the headline rate of inflation drops to 2%, job done, guys. So they are looking at these other underlying data points which are critical, and they've made that very clear. Obviously, one of the issues is that you've got the Fed, which has basically pivoted. They started using softening language, and so next year, if the Fed does start cutting rates and if the ECB starts cutting rates, can the Bank of England hold the ground? I mean, you wouldn't expect them to be able to do that. So there's going to have to be some moderation in the language. There's going to have to be some reaction to this news, as you say. But I think it's going to be linguistic rather than active at the moment.
Chair Powell is somewhere watching the show, covering his ears and shaking his head based on what you just said. John, your response to that, do you agree?
Yeah, and I think the other thing we have to remember is that central bankers are all human. So, firstly,
Are they?
I know. Well, okay, yeah, we hope so.
Maybe
AI could replace them. That would be good.
Yeah.
But no. So obviously, this year the Bank of England has come in for an awful lot of flack for basically being too late to deal with inflation, and also for not looking at things like the money supply and thinking about how that would affect inflation. So now you've kind of got this point where, and also remember, there's 3 members of the MPC, 3 of the 9, voted for a rate hike last time. So those people are unlikely to kind of change their minds that quickly, because that's just human nature. And I think the other big issue is that in April we've got a load of resets. So we've got the national minimum wage goes up by nearly 10%. The state pension goes up by over 8%. And the working age benefits go up by, it's kind of close to 7%. So no one is entirely sure how that's going to affect the UK inflation data at that point. So I suspect that, yes, in February we might see a kind of a relaxation, a kind of talking more dovishly. And obviously a lot of it depends on the Fed and the ECB too. But I think until we've got past that April kind of hump, the bank's going to be a bit wary of actually actively cutting rates.
Well, it's interesting that we're talking about actively cutting rates. And John, I'm going to put you on the spot here, because one of the big, because I haven't done that already, one of the big market questions I have is the dislocation, specifically when you look at cable and you look at Eurodollar. Specifically, you're seeing so much weakness coming off of what Phil would call the Fed pivot. But essentially this idea that because so many rate cuts are being priced in, the weight on the dollar is creating a tailwind to the euro and cable. I mean, it's great for me as someone who needs to exchange money, but it may not be for if we start to see some sort of return to normal for cable. Do we see that return to normal in the first quarter of next year? In terms of the pound getting stronger against the dollar? Correct.
I mean, that would, I mean, possibly, and given the amount of sort of systemic bearishness there has been attitude-wise to the pound, I think the fact that, it's like holding a ball underwater. If you let it go, it might pop up quite strongly. But at the same time, I mean, when you look at where the pound is, getting back above $1.30 would not really hurt anyone particularly. And I mean, the other good thing is it would reduce inflation, reduce kind of pressures on consumer, might offset some of the, because obviously there's the risk that the turmoil in the Middle East spreads and that pushes the kind of oil price up. So a stronger pound would help to insulate us from that. So I can see the pound getting stronger, but I don't think it would be a problem. It's a really interesting dynamic. Of course, it's not going to be a problem for someone who's a Brit. That's not the concern there. John Stepek, Philip Aldrick, we have to leave it there. We thank you both so much for joining me this morning. Of course, if you haven't already, do not forget to check out John's newsletter, Money Distilled, straight into your mailbox every weekday. You can subscribe on Bloomberg.com. Now, coming up on the show, we dive into British retail. We look at the holiday season so far.
what we can expect for 2024. I'm fully expecting a Christmas dinner in the next few minutes to somehow manifest. Stick with us. This is Bloomberg.
I do think people are spending later because they're just being more careful about what and where they spend their money and what on. And I think, you know, the days of just going out and spending a lot of money having a fantastic Christmas, I think are much more muted this year, and people are just being much more thoughtful. But it's good to see that the train strikes aren't there. The supply chain issues aren't there this year. We haven't had those really significant winter storms over Black Friday, which means that the courier businesses can never catch up if they get behind at that point. So it's felt like it's much more organised and much more stable this year, and it's good to see. But also people are coming back into shops as well. I think what happened over COVID was that people were saying that it was the end of shopping and everything was going to go online. And I think what we've seen over the last couple of years is the resurgence in shopping in real life, which of course is what Fortnum's is all about.
Fortnum Amazing CEO Tim Athearn there on how he thinks in-person shopping is having a Christmas comeback. Now, the run-up to this holiday has been a tricky one for British retailers to navigate, while wage growth now ahead of inflation. Well, the cost of living crisis, heating bills and borrowing costs still all weighing on consumers. And on top of that, weaker than expected retail data raising concerns of a recession. Joining me now for a deep dive into the British retail story, Bloomberg's Katie Linsell and Deidre Hipwell. Katie, I want to start with you here. A lot of doom and gloom out there. This cost of living crisis, I think there was a big expectation. If you had asked me January of this year what Christmas of this year would look like, I imagine a lot of people would have said, well, actually, it might be a little bit of a lean Christmas. Any indication of that?
I think, yeah, if we look at the data that we have so far, we can look at November retail sales, which came in much weaker. It was growth, but it was much weaker growth than a year earlier. And if you look specifically at retail sales outside of food, they actually fell. And, you know, November is already consumers sort of gearing up for their Christmas spend. So that's really not what we want to see in November. We want it to be a much kind of stronger reading. So I think shoppers are pulling back, and they are sort of watching their spend as much as possible, especially on things like gifts.
Deidre, your Christmas shopping over?
No, I tend to be a last-minute merchant doing it at the end. But I do think, to Katie's point, I think a new reality has set in, because even though we had a surprise fall in inflation last month, most households in Britain are facing higher mortgage bills, energy bills, council tax bills. So I think that's going to have really affected how people are approaching Christmas. And I think some people might have been trying to spread the spending, and certainly some people will be trading down to cheaper brands.
Does it influence, you mentioned cheaper brands there, what is actually getting bought in terms of gift giving?
Well, I mean, if we're looking at what sectors I think are going to do well in Christmas, I'll certainly say food will probably be the winner, because for households that celebrate Christmas, you might economise on gifts, but you're all most likely going to have a meal. I think in terms of other non-food sectors, probably some fashion retailers will have been doing okay, because obviously people are buying outfits to go out. We've heard a lot of talk about sequins being back in, and M&S, and next we're talking about, you know, sequin skirts and sequin blazers selling well. Also, electricals can be an item, but obviously they're a higher price. So I think it's really going to be quite hard until we see the January trading statements.
That really appeals to the 5-year-old inside me. I love a little sparkle. Katie, talk to us about what she specifically said in terms of leaning into food. We'll put the sparkle analysis on pause for a second. Let's talk a little bit about food, though. Luxury food, first off, is something I had to Google in the United Kingdom. But talk to us a little bit about what that actually looks like.
So I think at this time of year, really, for shoppers, they are trading up as much as they can within the food shopping that they're doing. So if that means sticking to the same supermarket that they're with all year round, they're looking for the more premium items, the sort of delicious panettones and the things that they can put on the table to really sort of impress their guests as much as they can. We also see some shoppers actually trade up to supermarkets that they don't normally shop at. That could be M&S, it could be Waitrose, because they really want to treat themselves at Christmas and treat their loved ones.
Yeah.
So we'll see some good trading at the supermarkets this year. And actually, if you look across the board at grocery shopping this Christmas, Kantar, who track data on this, expect a record £13 billion of spend, of sales, in supermarkets. So it's going to be a sort of bumper Christmas for the grocers. They're probably quite happy.
And we actually just showed a visual of what a Christmas dinner might actually look like. If you look at the inflationary numbers, Deidre, Deidre, you're actually seeing it's only 5% more expensive than last year. I'm saying only, and we have that beautiful graphic up once again. I say only 5% because compared to last year, it was about a 20% increase on Christmas dinner. Your initial take on something like that?
Absolutely. We have started to see in the last few months food price inflation starting to fall, but it is still a lot higher than it would have been, say, 2 or 3 years ago. So we are entering an environment where food prices in Britain are structurally higher than they were. But I would still say that Britain has one of the most competitive food markets in the world. So we're probably still getting a better deal than in most other countries. And one thing to point here, of course, the supermarkets have really been pushing their loyalty cards. So if you are a member of the loyalty scheme like the Tesco Club Card or Sainsbury Nectar, you will be getting better prices for your Christmas dinner. If you're not one of those members, then you might actually be paying a bit more. So shoppers will need to be savvy about how they shop for their Christmas dinner.
Do you think this is a temporary trend that you're seeing, though, in Christmas when it comes to food, the sequins, even the kind of going to different stores as well? Going into 2024, what kind of precedent is holiday season setting?
Well, I mean, every Christmas is different, and obviously we're going into a period where we're coming out of a historic inflationary surge. Most people haven't had inflation-busting salaries. So I think this Christmas could be a leaner Christmas. So we could go into 24 potentially with some profit warnings from retailers. And certainly we've already seen some profit warnings. For example, Superdry, they've pointed to the fact that because of a warm autumn, they haven't sold as many coats as they would have liked. So that means some retailers are going to be heading into January with excess stock that they're going to have to flog at discounted prices. And I think just apart from the Christmas trend, we've had a number of the really big household retailers in the UK, M&S and Next, and they're both doing quite well at the moment, but they've pointed to a much more cautious tone in 2024. I just think at the moment it's just really hard to see what the consumer is doing, because some elements of the consumer sector is fine, but then others are really pulling back on spending.
It's funny, we're talking about warm weather to someone who actively wears 5 layers every time I venture out into London. Katie, we'll wrap it up with you here. When we're talking about the warm weather story, what is the impact on retailers? Does that mean more in-person shopping, like Fortnum and Mason CEO was saying?
I think on the warm weather point, it's the concern that October was much warmer than we were expecting, so it sort of delayed some of that typical winter spend. You know, people buying the really kind of pricey items like winter boots, winter coats, all this sort of thing, all came in later, which has been a nightmare for some of the retailers. But yeah, if we focus more on the fact that this year it is maybe a little bit warmer than we could have at this time of year, and so we did have snow last year. You know, we did have people actually choosing not to venture out to shops.
Yeah.
So I think to that point that we had from Fortnum & Mason, yes, shoppers are going back into stores. I think we all have in our memory COVID lockdowns, and when we can get out, we really want to go out to stores and spend time with our friends and family. So yes, people are out and about, but the question is really how much are they spending? That's what we will see in January when the updates come through.
Yeah, a lot to digest there. Katie Linsell and Deidre Hipwell still wrapping up their Christmas shopping. Bloomberg experts on UK's consumer and retail. We thank you both for your analysis this morning. Coming up, after only a handful of companies have listed shares in London this year, UK regulator looking to change that for 2024. We're diving into it next. This is Bloomberg. The UK's finance regulator has set out its latest plans to simplify its listings regime. It's hoped that the move will revive interest in London's stock market after the Cambridge-based technology giant Arm, well, chose New York instead, spurning some of the calls, from the UK government for a dual listing. Joining me now, more on this, Bloomberg's Catherine Griffiths. Catherine, that was quite the burn, I have to say, from London, or for London, I should say, from New York. The government very motivated to change that trend. How much of a difference do you think they can make?
Well, I think they can make some difference, and I think people who want to see real change believe that there needs to be lots of different things that happen, and certainly some of those things are changes to our listings rules in the UK, and that's an area where the government has focused. But there are all these other issues which are sort of much deeper and more complicated that there's been a lot of focus on this year in terms of how we get big pools of capital here notably in the form of the insurance funds and the pension funds, to actually invest in UK equities, UK infrastructure. And many people end this year feeling fairly frustrated and let down by the government on that.
So what is the actual fear here? What is spooking investors? Do people just not want to, make the trek across the Atlantic to hop to London, or is there more to it?
I think in many ways, actually, internationally, the UK is seen as a better place than it was a few years ago. When you talk to some really experienced people in the city, they make the point that we go into 2024, an election year in many, many countries, and actually the choice in the UK between two fairly centrist candidates, Rishi Sunak and Keir Starmer, is a reasonably good place, and they want to see rule of law and predictability, and they feel the UK is in a better place now than it has been. That said, there's still this feeling of stagnation, that the UK stock market is a place of kind of historic companies, old-fashioned companies. And while we have a great sort of tradition in universities and startups, it's not really translating into the sort of creation of these big tech giants that, of course, we see in the US notably.
All right, very quickly then, we have some news that UK Chancellor Jeremy Hunt heading to Switzerland. How much of a difference could that deal make?
I think it's a great element to have this deal with Switzerland. But, ultimately, they're two reasonably small places coming together. The big hope post-Brexit for many people was that the UK would get a special deal with the US, and that remains elusive.
Yeah, it's a really tricky post-Brexit situation, but I wonder if Switzerland then sets the precedent for some of the other countries that the UK is trying to win over, for lack of a better term. Bloomberg's Catherine Griffiths, we have to leave it there. We thank you so much for joining. That does it all for this week's edition of Bloomberg UK. Of course, you can tune in every single week. Coming up next, we have Bloomberg Brief. I will be with you to set you up for everything you need to know for the U.S. trading day, as well as how some of these kind of holiday markets are influencing everything you are seeing on your screen. We're going to dive into some of those corporate stories and, of course, an all-star lineup. But for now, you are seeing a little bit of red on the screen when it comes to these European markets. Stick with us. This is Bloomberg.